Good afternoon, everyone. It's 1:15 in the UK here. Beautiful, beautiful day in West London. And we'll start in 15 minutes. Welcome to our webcast, the 10-Minute Investor, where I'm going to show you how to consistently outperform the stock market in a few minutes a day. So there is a little chat box. And if you would like to practice just saying hello, please feel free. But in the absence of that, we'll start at exactly 1:30. Promise not to keep you too long. 40 minutes to an hour at the very most. A few minutes a day. I'll say hello again at about 20 past and again at about 25 past. Good afternoon, everyone. It's 1:20. Daniel, if you're listening, first of all, just let me know, please, that you can hear me okay. And secondly, I'm going to talk about three things. One, the barriers that get in the way of becoming consistent. Two, how to find really, really good shares. And then three, how to manage them relatively simply and quickly. How does that sound, Daniel? Good afternoon, everyone. It's 1:25. Welcome to our VectorVest webcast, the 10-minute investor, where I'm going to show you how to outperform the stock market in less than 10 minutes a day. And we'll start in 5 minutes. Looking forward to it. Great to see you all. I've done a sound check, and I've been told that one of our customers in North America can hear us, can hear me. So there's a little chat box, and if any of you want to say hello, it'd be a pleasure. Paul, there'll be slides. and you should be able to see my first slide on your computer now. The chap in the hammock. Yes, I will, Daniel, talk about that. Okay. I'll talk about when to enter a stock. And Paul, you can put your questions into the chat box, and I'll do my best to try and answer them. At the end of the presentation, I'll give you my email address. And I'll post some Stoke-on-Trent, okay? Be going through there in the next few days on my way to the Manchester user group, Paul. So it's 1:26. Let me finish the last of my tea here. Beautiful day in West London. I don't know what it's like in Stoke, Paul, but a magnificent spring day here in Pembroke Square and Notting Hill. Bright blue sky. It's chilly outside, but not bad at all. Not bad at all. Daffodils in my square here, Pembroke Square, in bloom this morning. So we're turning the corner. Another month, the clocks will change and all will be good. Yeah, and Paul tells me it's sunny and beautiful up in Stoke-on-Trent as well. That's great. All right, folks, 7 minutes to go. I promise I won't keep you too long by long. Hi, Paul. You should be able to hear me now. It's 1:29, folks. We're going to start in a moment. Paul, can you hear me okay? Cool. That's great. I was just finishing the rest of my tea, sir, and I didn't want you to listen to that. We'll try and cover both, Daniel. We'll try and cover both, but I think it's mostly a medium to long term. There's a limit on what I can cover in an hour, I'm afraid. So. Good afternoon, everyone. It's exactly 1:30, and it's time to start our presentation. I've done several sound checks, and the sound seems to be coming through okay. Welcome to the 10-Minute Investor, where I'm going to show you how to consistently outperform the stock market in less than 10 minutes a day. Now, just so that we're all on the one page, I'm not saying that we're going to buy a stock at 10 o'clock and we're going to sell it at 10 past 10. It's not day trading or short-term scalping, but much more like this fellow in the hammock, where you can come home from work, you can come home from the golf course, and keep your portfolio under control with a 10 minutes focus a day. So that's what we're going to try and achieve. All right. So, my big promise to you today, folks, is that if you listen and listen to the end, that you'll be well on your way to investing with confidence and consistently outperforming the market in a few minutes a day. So please bear with me for the next 45 minutes. And that's me. For those of you who don't know me, I'm David Paul. I've got a PhD in mechanical engineering, MSc in metallurgy, and a BSc in mechanical engineering. I'm 63. I'll be turning 64 this year. Photograph was taken at the New York Stock Exchange, about 18 months ago, I suppose. I put on my first trade in October 1982, and I traded while working for De Beers. I was living in South Africa at the time, and in April 1988, I cut the corporate umbilical cord, and I've been trading on my own ever since. And along the way, under duress, I started to do some seminars in the stock market purely by accident. The very first seminar I did was the speaker, in fact, got laryngitis, and they didn't have anybody else. So I was dragged up, and under duress, I spoke for a couple of hours on what I was doing personally. And that was so well received that a desk head of a major bank, in fact, asked me to come in and, in fact, coach his traders in how to become consistent. That was the objective of what he wanted from me. And that led to a career in coaching mostly institutional traders. And for a very long time, I've coached traders at all of the banks around the world, most of them in London, all of them in South Africa, and certainly most of the major banks in Southeast Asia. I've coached how to become consistent in the stock market, in the futures market, and in the Forex market. So today we're going to talk about the stock market. So you might be saying to yourself, it's a wonderful day outside. What the hell am I doing here? Folks, you're in the right place. If you're tired of buying stocks and the darn things fall out of bed after you've just bought them. Okay, so I'm going to try and fix that. I can't fix it across the board, but I can push the probabilities of success and put those at your back so that 7 or 8 out of the 10 should go your way. And you're in the right place if your stocks, in fact, become profitable, but you give it all back because you don't know when to get out. And without a doubt, knowing when to get out is actually much, much more difficult than knowing when to get in. And we'll talk about 2 places to get out. How do you get out when you've got a profitable trade? And of course, when you get out when the 2 to 3 goes against you. So we'll do our best to try and cover that. I think that in this day and age, we're all busy earning a living, jumping back and forward, taking kids to school, God knows what. And you're in the right place if you feel you don't have enough time to manage your stocks. I'm going to try and show you how to do that in a few minutes a day. And I think this is the most common one when I do seminars, that the market has kicked the confidence out of you that you can actually make money in the market. And when I do these seminars live, that's what comes up more than anything else. And you're in the right place, folks, if you just want a simple way to buy the right stocks at the right time. All right. So today, 3 things, folks. The first thing is how to move from inconsistent to consistent. And I think you would agree, consistency is the name of the game. There's no point in making £1 million and giving it all back again. And the old adage is that it's very easy to make money in the stock market, but bloody difficult to keep it. The second thing is we're going to look at how the top investors pick stocks. And I can speak about this for a great deal of confidence because I've been in and around the dealing floors of the world for a very long time. How the top investors pick stocks. And then the third thing is a 10-minute portfolio management plan. So that's what we're going to try and achieve. It's one heck of a job in a few minutes, but I'll do my best. All right. Anybody, any comments on that? Just put them into the chat box. I'll do my best to try and answer them. Now, if you do stick through to the end, I'm going to give you a little template that you can create your own plan to tick the boxes. And personally, I'm very much a tick the boxes player. If I do my homework and I sit down and I go through all the checklists like a good pilot before he takes off, then there's a high probability that I'm going to make money. If I trade off the seat of my pants, well, anything can happen. So folks, you've heard a little bit about me, but this seminar, this talk, this webcast is not about me, it's about you. So what's the hardest part of making money in the market for you? So get your little pinkies on that chat box and let me know, please. What's the hardest part? Finding the time to do anything is coming up here a couple of times. Yeah, it's a busy little life, that's for sure. Any comments there, folks? Any more than that? Knowing when to sell, I'm getting. Knowing when to sell is coming up again. Market noise, Paul says. Yes, market noise is it can lead you to that fellow who's totally and utterly confused. Daniel says how long to hold the stock, and that again is very much on exits, Daniel, and there's no hard and fast answer to that. My style is that of a swing trader, but we have lots and lots of colleagues of mine who are much longer term players. And we'll try and answer that a little bit later on. Paul, at VectorVest, we have a technique called the Midas Touch, which does its best to smooth out all of that market noise, but I won't be able to talk about that today, I'm afraid. I haven't got time to talk about that today. So exits are coming up. Having the time to do anything is coming up, and market noise coming up over and over again. So let's try and handle these things. If you're struggling, folks, you're not alone because most investors fail. And this came out of a study published by an American lot called Dalbar. And they looked at the S&P 500 and average investors' results over a 20-year period from 1995 through to 2015, and all sorts of markets there. From 95 to 2000, there was a roaring bull market, the like of which I don't think we'll ever see again. It was an amazing time. Shares were going from $1 to $50, totally worthless, and they gave it all back again. An amazing time. Over that period, the S&P 500, which is a proxy for the American stock market, the largest 500 companies by market cap, produced an 8.19 annualized return. The average stock investor made 4.67, and the average mutual fund did the same, folks. And thus the rush to indexing. The fund managers say to themselves, we can't beat the market. Well, let's get paid and be the same as the market. Inflation was 2.2%. So the average stock investor still outperformed inflation, but he did much, much, much worse. And thus the rush to indexing. It's very easy to get like this. And Paul, with that market noise up in Stoke there, I'm sure you've been like that a few times, where it just gets on your nerves and you want to kick the dog. Easy to label yourself as a failure, especially if you come from a very quantitatively orientated business like engineering. But folks, if you know what you're doing, and you've got a plan, you don't stress about your trades. Okay. You've got things under control. And you can trade with confidence. And that's where I want us all to get to. So section number 1 is how to move from inconsistent to consistent gains. But I have a question first. Okay, there's 2 polls. I got confused. Sorry about that, guys. We've got 2 polls. We've got Paul from Stoke and another Paul Bailey. I don't know where you're from, Paul. 2 Pauls in the room. And I'm David Paul, so we got 3. People call me, I get called Paul all the time. How to move from inconsistent to consistent gains. And Paul is from Manchester, of course, yes, Manchester. And consistency is just so important to get yourself to that point where you can rely on building your wealth, maybe not like a sports car, but building your wealth consistently. If you're trading for income, that you've got a nice, steady income coming that's similar to the salary you get, that's similar to a drawing from your business. And that gives you peace of mind. And that's what we're going to try and get to. So I've identified 4 mistakes. And just by knowing about these mistakes, it's going to help you get your mind and plan your actions around them. And these mistakes, folks, are based on my experience in looking at retail and institutional accounts over the last 30 years. So the first mistake, when I do seminars at the banks, I spend a full morning on this. And I haven't got a full morning here, but it's so easy to lose sight of this moment, and you think of the money first. Now, you will say, well, the whole point of being in the stock market is to make money. But you just think of any professional. If you think of the dentist, your dentist that lives in a big house at the top of the hill, he's got a big Merc and his wife's got a Porsche Cayenne. He is successful because he focuses on perfect execution of each and every treatment. And if he does that, his waiting room will be full and he pretty much can charge what he wants. Now, your job as a trader, folks, is to focus on perfect execution of each trade or investment, depending on your time frame. Not allowing your mind to worry about one that went against you or one that might go against you, but focusing on perfect execution of this one trade over and over and over and over again. Now, I spent a long time in South Africa, and one of my best friends in South Africa is a golfer called Ernie Els. And Ernie, when he was playing top-class golf, had 2 psychologists to help him stay in the moment so that he would focus on perfect execution of this one stroke. Not the last stroke, not the next stroke, but this one stroke. So your job, ladies and gentlemen, is to make perfect trades. Okay. Now, I can rattle on about this for a very, very long time. As I say, at the banks, I spend a morning on this, on how to actually become present and focus on this moment. When you're not present, it's so easy to be like this fella, becoming incredibly emotional about what you're doing. And my engineer's definition of emotion is it's your body's response to a thought. So just look at this fella. Okay. Look at the decisions that he's making now compared to the decisions that he would make if he was relaxed at home in his armchair. So if you've ever said, and don't laugh at my attempts at PowerPoint, please. If you ever said, I know it's down now, but it'll come back. Both Pauls, Paul in Stoke, Paul in Manchester, have you ever said that? It's already down 20%. I might as well hold on to the damn thing now. I've got a profit now, but if I close it now, it'll keep going up tomorrow. I know I lost more than I thought, but if I close it now, it'll probably go up tomorrow. The last time I sold a stock, it kept going up, so I'm not selling this one yet. So, folks, if you've thought those, and we've all thought those from time to time, there's a whole gamut of emotions there: frustration, fear, greed, despair, hope. Hope is not a strategy, my dear friend Larry Pacevatis, who's one of the inspiration to me, a Fibonacci trader, says. Hope is not a strategy. Yes, Paul, we've all said that often, that's for sure. So, staying in the moment, folks, is the only way to sidestep fear and all those emotions. And it's what is taught to special force soldiers all over the world, so they can stay in the moment when some other sword is shooting at them. And if you read the greatest coach in golf, Bob Rotella, if you read his books on how to produce a champion golfer, and take a bottle of Tipex with you and Tipex out golf and just type in trading, you'll find that the book's a wonderful text, Bob Rotella. So that's fear number one. Fear number two forces buying stocks that are falling. And we seem to have been indoctrinated into this. It's the old 2 for the price of 1. Gurus talk about pound cost averaging. And that 2 for the price of 1 has bankrupted more traders than anything else in my experience. I'll give you an example. My son still lives in South Africa, and he's a stockbroker out there. He has his own fund. And there's a biggest mattress company in the world called Steinhoff, listed in Johannesburg, listed in Germany. And before Christmas 2017, it was trading at 125 South African rands. It fell the whole way to 1.25 South African rands. On the way down at 12, my son got an order from a guy to buy 3 million shares at 12 South African rands. He tried to talk the guy out of it because the share was falling, but the guy was adamant that that was the bottom. And it fell to 125. So there's an old adage out there: I've never seen a share too low not to go lower and too high not to go higher. So it may work on exchange traded funds, it may work on unit trusts, but it certainly does not work on shares. And in the UK, we have those infrastructure companies that seem to be going bankrupt by the moment. Bluest of blue, Standard Life has fallen out of bed. Aberdeen Asset Management and Standard has fallen out of bed. So it's so tempting to try and buy them on the way down. There's a share called Windstream. I did this presentation for the Americans a few months ago. And one of the chaps phoned in and he said, there's a double bottom and this share has broken a trend line and it's come back and kissed. And he bought the darn thing here. And he asked me, was that the right thing to do? Now, there's some more evidence I'm going to present a little bit later, but this share is in the throes of a very strong sell-off. And I said to myself, that's not a good place. And I told him that I didn't think, I'm not allowed to give financial advice, but I didn't think that it was a good idea and I wouldn't buy it. And that's exactly what happened. It was a false break and it gaps down the page. So you couldn't have got out till about here. And it just keeps on going. Okay, so don't buy shares that are falling. The third mistake is holding on to losers too long. It took me a long time to find that chap in the vest. Holding on to losers too long. And Every year, folks, you're going to have in your portfolio, you're going to have 2 great stocks, massive runs, and you're going to have 6 or 7 that do reasonably well, and you're going to have 1 that falls out of bed. Okay, and if you hold on to that loser too long, that's going to cause you problems. So knowing when to get out, and before you get into a trade, you should have in fact calculated when to get out. Our VectorVest program calculates a stop loss for us automatically, which is optimized to be well out of the traffic, but that's something you need to think about. Holding on to losers too long will, one bad one, like that Steinhoff, will cause you a great deal of grief. No exit plan, jumping out of aeroplane without a parachute, and that's Windstream falling off the park. This is a share that one of our students, a lady, bought it. She bought it somewhere here. For some reason, I don't know. People buy shares, guys, for all sorts of reasons. Many of them have got nothing to do with the share itself, but the share tanked against her. So I said to her, why didn't you just get out? And she said, well, her husband says that it's going to come back, like we've all said. So what's happened is that they're still sitting in the share. They've lost the opportunity cost of putting that share to work somewhere, that money to work somewhere else. And it's also caused a little bit of strife on the home front. And those of you that have fought the home front will know that it's the most difficult battle at times. So you don't need that in your life. You need to know exactly where you're going to get out if you are wrong. And the last is market direction, folks. The market direction is like a big wave if you've ever done any surfing. Okay. In my youth, I did a lot in a place called Durban in South Africa. Great, great waves. Apart from the sharks, it's a wonderful place to be. Came very close to them on many occasions. And again, the chaps on the TV keep rattling on about buy and hold. My father told me that at the stock market high in 1969, it took a full 20 years for the London stock market to actually break a new high in real inflation-adjusted money. 20 years it took. So buy and hold is the way to go, is absolute rubbish. In the London stock market at the moment, it's done absolutely nothing. The FTSE is sitting at the same level as it was 20 years ago. But along the way, there's been many ups and downs for wonderful trading opportunities. And the stock market, folks, is like this fairground roller coaster. It takes forever to get up there, and it falls very quickly indeed. And that is the American market, folks. And that is 2000, and there's the 2000 to 2003 bear market. We then get this massive run up into 2007, and what is known now as the global financial crisis, and the bull market that would still seem to be running. And in 2008, the S&P fell 38%. The FTSE fell a similar amount. And if you lose that, you've got to do one hell of a lot of fancy footwork to get it back. And many people have never got it back because this sell-off caused them such an emotional upheaval that they just didn't have the stomach to get back into the market again. And I know many, many people, very rich people, or at least they were very rich people, that are still sitting in cash 10 plus years later because they were traumatized in that sell-off. Can everyone still hear me out there? I haven't had a comment in a little while, and talking to yourself is clearly not a great attribute. I think everything's okay. Good, Paul. Thank you. Very kind. So knowing when to be in the market, folks, and knowing when to be out of the market, or if you've got the stomach for it, shorting the market, And you can certainly do that. There are spread bets, there are exchange traded funds where you can actually profit when the market is falling. And of course, you could simply just get out of shares, go to cash, or what I do is go to bonds. So lots and lots of things you can do to make an income when the market is falling. But it's really, really important that you know when it's safe to be in the stock market and when it's not safe to be in the stock market. You can do this by moving averages. I don't use moving averages myself because of that roller coaster, because the moving averages do a good job on the way up, because the market tends to be quite slow on the way up, but they don't do much of a job on the way down because it tends to fall very fast, and the moving average, being a lag creature, gets you out quite late. So at VectorVest, we have our own market timing systems, but you need to know within your time frame whether the wave is at your back or whether the wave is against you, because the wave carries everything with it. And this was a chap who got caught in that sell-off. It was a ghastly sell-off, folks. Robert, and he says he used professional advisors for direct shares and funds, and he retired just at the top of 2007. And by 2008, he'd lost 40% of his retirement savings, and the poor chap thought he was going to have to get a job. God bless him. And later on, I'm going to show you how Rob, in fact, turned that around with VectorVest's help within that 10-minute management plan, which is section 3. So which of these has cost you most, folks? Becoming emotional, buying stocks that are falling, holding on to losers too long, or ignoring market direction? When I started, it was number 3, because in October 1982, I put on my first trade, and between October 1982 and the middle of 84, I put together quite a bit of cash, certainly quite a bit of money for me at that time in my life. And in 1984, I bought into a share, and I was sure it was going to go up, and of course it didn't, and I held on to it and held on to it and held on to it, and I pretty much gave back all I made in the previous couple of years. So which of those has cost you most? Get a lot of number 2, a lot of number 2. 1, number 4, market direction. Certainly if you were in the market in October, November, December, it was pretty much impossible to make a buck on the long side because the market was falling and falling very fast indeed until the period between Christmas and New Year, where the Fed made some dovish comments, and we had the best month. January is the best month in the last 32 years, I read. Number 3 from Paul in Stoke. Number 3, in a 10-share portfolio, there's always one, okay? And if you don't nail that quickly, then that can cause your year to go to hell. It really can. So let's try and fix these mistakes. And the fix, and I always do this in this triangle. The first part of the triangle is stock analysis. I want to fully analyze the stocks that I hold and the stocks that I'm interested in buying. I want to know whether they're undervalued or overvalued. I want to know, are they growing their earnings? First of all, are they making money? Are they growing their earnings? What's the earnings growth been like over the last few years? Has it been steady? Has it been up and down? So I want to fully analyze the stocks that I've got. The second thing is that I want to have a stop loss for every share in the market, and I want to have a strategy for getting out when I'm correct. That strategy could be a simple trailing stop loss. And at VectorVest, we've got several very innovative stop losses. one called the profit locker that uses volatility to give us a stop loss that will keep us in the market when the share's going our way and kick us out quite quickly when it isn't. So a stop loss when we're right and a stop loss when we're wrong. And the stop loss when we're right, you can either have a target, which is what I do as a swing trader, or as a position trader, you can have a trailing stop loss that allows you to the share to run. That could be as simple as a 20% trailing stop loss. Third thing, we need to have a buying signal. We need to know, folks, when the wave is at our back. So there's a safe time to be in the market and an awful time to be in the market, and you need to be able to differentiate between those two states in whatever time frame you're trading in. We want to find the very best stocks for our portfolio. And the last is a plan to make it all come together. So which one of those do you need to invest in first? I found that when I went through this process, that it was the first one that I needed to work on, because the fundamental analysis of stock valuation and earning safety, as a mechanical engineer, I found very difficult. So I largely broad brushed over that for the first 20 years and traded purely technically. The rest I had pretty much under control. And when I added stock analysis to the mix, two things happened. One, my hit rate went up significantly. And secondly, my risk to reward went up. In other words, the amount of money I made when I was right, in fact, went up in relation to what I lost when I was wrong. And that increased the profitability of what I was doing enormously. So which one of those, I'm getting exits here, which one of those do you need to work on first? They're all equally important. So how do top investors pick stocks? Well, it's so darned easy to get buried in data. Look at this, all sorts of stuff. One of our competitors sends that out. Where do you start with that? And that was me. I didn't have the right tools. I'm a mechanical engineer. I have no formal financial education apart from what I've had to do recently to become the compliance officer for VectorVest UK. So I didn't have the right tools. And I remember vividly trying to get my mind around valuations and earnings growth and earnings safety and all those financial ratios. And I remember vividly the annual reports and the interim reports piling up in the corner of the office. And I just got overwhelmed by the job. I didn't have the right tools. And it takes a lot of time. And Kramer here says that it takes an hour a week per stock. And if you're holding 10 or 15 stocks, well, you've just got yourself one hell of a part-time job, 15 hours a week. So I need to be able to get to the good stuff much easier than that. So it's so darned easy to get completely and utterly confused. Convinced you see something, but what I want to do is I want to get to the numbers and I want to get to the analysis very quickly so I can spend my time, ladies and gentlemen, on what's really important. And what's really important is focusing on managing and executing the trade. So I want to get to those numbers in terms of valuations, earnings, earning safety, trend. I want to get those numbers all at my fingertips for every share in the market. I want to get it quickly so that I can focus on what's really, 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 really important, which is execution. I hope that makes sense. So the fix. Dr. Toledo, who's the founder of VectorVest, makes this wonderful analogy between a football team and buying a successful portfolio, where he says that if you fill the football team with really great players, that alone will in fact help the team do well. And similarly, he says that filling your portfolio with really, really good stocks, that on its own will help you along the way. So I've got a checklist here. Before buying any stock, the stock price should be steadily rising and not too volatile. So I'm saying that I want to buy shares that are already rising in price. I want to find a company that's making money and their earnings are growing, and I won't favor shares that are trading below their valuation. I was taught this very early on in life. My old granddad used to say that the only way to make money in anything is to find the value of something and then pay less for it. And a little quiz, folks. 1, 2, and 3. Those are daily bars of 3 shares over the last year. Which one would you feel most comfortable in buying if you only had one to buy? Which one? Question coming in thick and fast here. I'm getting 3, 3, 3, 3, 3, 3. Well done, guys. Because share number 3 is already doing what you wanted to do. It's rising up the page. Number 1 is falling down the page. I assure you, folks, that if you get that bottom, if that's the bottom, you've just been lucky. There's a wonderful expression. I traded on the floor in Chicago for a year in my youth. And there's a wonderful expression in Chicago. They say that top and bottom pickers become cotton pickers. Another great book out there, I read too much, I know, but there's a great book. It's called Reminiscences of a Stock Operator. And I assure you that I could not spell reminiscence if I tried. The hero is a guy called Larry Livingstone, who, and that's a pen name for a great speculator called Jesse Livermore. And the book was written 100 years ago by a journalist called Canadian Edwin Lefebvre. And he says, and I've already quoted, he said, I've never seen a share too low not to go lower and too high not to go higher. And that's our little friend in South Africa who bought 3 million shares at 12 rand each. And the damn things fell to 145. Number 2, well, it'd be so easy to say I buy there and I sell there and I buy there and I sell there. And when you're sitting at your computer at night, it looks so darned easy. Okay. But it's much more difficult on the hard right edge, folks. Now, this share is already doing what you wanted to do. And all you had to do, I'm not saying for a second that we don't buy a pullback and an uptrend, not saying that for a second. But nevertheless, we've got this wonderful big trend up the page here. And as you can see, that support, that resistance became support. And we've got this thing moving up the page strongly. And all you had to do was to buy breakout after breakout after breakout, and you would have made some money. The institutional traders would laugh at somebody trying to buy bottoms. Okay, that's a retail prank. So that's the first thing. Now, that's number 3. I've transposed it here. And down below, folks, I have a plot of the earnings per share. Now, at VectorVest, we have a forecast earnings per share for every share in the stock market. And I'm going to quote another wonderful book. And the author of the book is a guy called Ben Graham. And Ben Graham's incredibly important because he's Warren Buffett's mentor. So he's a chap that has to be taken seriously. And he's written a book, again, it's the guts of 100 years old, called The Intelligent Investor. And it's been upgraded with modern examples quite a few times along the way. Here's what he says in the book. He says that earnings per share growth is the engine that drives the share price. Never forget that. If a company is growing its earnings, if the company's making lots of money, it can invest in research and development. It can attract the best people. It can pay for marketing to grow. And it also can grow by acquisition, where it will buy a private company on a price to earnings ratio of 3, and immediately that company will be revalued to whatever the company, the acquiring company is paying, is on the market. So if it's on a PE of 15, then the company that's being bought immediately is revalued to 15. So earnings per share, and I like to see earnings per share rising smoothly from the bottom left to the top right. And in this example, this share over the last year has grown earnings per share from $3 to $4.50. So a 50% growth in earnings per share. And there's quite a few of those around in both the London stock market, especially in the American stock market. So earnings per share, folks, and I know it's anecdotal, but the smoother the earnings per share growth, then the easier goes the trading, in my humble experience. Now, the next thing is value. And I'll never forget my granddad saying that the only way to make money in anything is to find the value of something and then paying less for it. Well, we want to favor undervalued companies. And every day, VectorVest calculates a valuation for every share in the market, so we can see at a glance, or we can search for all those shares that are trading below the VectorVest valuation. And that alone is an incredible edge. Now, so there's the little checklist. Stock price is steadily rising, not too volatile. The company's making money and those earnings are growing. Favor undervalued stocks. Now, we go back to when, and that fellow, remember the chap, I think he was Steve, who bought there, and there's the double bottom, and he was betting that this resistance would become support. An old technician's trick. I didn't like it because I was buying a share that was falling. I'm much happier buying it here. But when we put the rest on, here's what I saw. I saw that the share was trading much above the VectorVest valuation, and the valuation was falling. But the main thing, folks, is that earnings per share was falling off a cliff. So the probability of that being a breakout, I felt, was very low indeed. And that's why I told old Steve to run for cover. Okay, so on this particular share, we would be, if we bought it, we're buying a share that was falling in price, which is dumb. We're buying a share where earnings per share is in fact falling rather than rising, and we're buying a share that was trading significantly over the VectorVest valuation. And by doing that, we put the probability of success at a very, very low number. Of course, this company could have done something absolutely magnificent and shot up the page, but the probabilities of that happening were low. Now, that's an American share called Covenant Transport. And earnings per share is growing strongly. It's undervalued, and it's just pushing up the page. All you had to do was to buy that little bit or buy that little bit. Those of you who are technicians will know that that's a beautiful flag pattern, and it pushed out of that flag very strongly indeed. So I'm not saying for a second we don't buy a pullback and an uptrend, but this earnings per share is absolutely inviolate. If you haven't got that, then if you don't see strong earnings per share growth, then the probabilities of that share moving up are relatively low. In the housing market, they say that there is three things: location, location, location. Well, in the stock market, there's also three things: earnings, earnings safety, and earnings growth. It all comes down to earnings, profits. If your little sweetie shop is going to make more money next year than it did this year, then your little sweetie shop is worth more next year than it is this year. It's as simple as that. And I don't care how many algos or dark pools are out there. If earnings per share is growing strongly, then the share price, assuming the general market is favorable, the share price will move with it. And at VectorVest, we don't have to sort of drudge our way around to find forecasted earnings per share. That's a part of the program. It makes life very easy indeed. Lots of these. Skyworks, been cracking. Southwest Airlines, am I going the right way? Advanced Energy, NVIDIA, broke up. Those of you that are technicians, if you see a share that's got rising earnings per share that gaps out of a consolidation, that's a sitter, absolute sitter, okay? So lots and lots of them, but I want now to have a look at the UK market if I can. So discard those, and let's go into the UK market. Now, what I did a bit earlier is that I wrote a search, and on that search, I'm finding shares that are less than the valuation. So I've got this stock price is less than the stock's value. I want the share to be growing earnings at one hell of a clip, 20% a year. And on VectorVest, we have a measure of earnings safety, which is called relative safety, and it's graduated on a scale between 0 and 2. And I'm asking for the relative safety is greater than 1.1, which is in fact fair to good. Above 1.3 is excellent. And if you were very conservative, you would push the relative safety up to 1.3. But here I'm just looking to get rid of all the dodgy ones. And when I ran that search, here's the shares that I've found. So I'm going to now chart those, and I'm going to graph those. And there we go. The first one's Elant. Now, to get a perspective of this, I always start with the weekly chart over 3 years. And there is Elant. And Elant is moving up the page now. There's the value. I'll make that a little heavier. We can see it. That's our value. That's my standard chart, folks. Now, earnings per share here is not, over the last 3 years, it's gone from 10 pence to 40 pence. The share is in the throes of a nice strong trend up the page. Came back to this support level here. And it's on a buy signal on VectorVest. This is very handy. It tells you when to get in and out. And this little trailing line is the stop loss. So that's the share. I'm actually holding the share myself. I have to make it very clear to you. VectorVest is fully authorized by the FCA. I have to make it very clear to you that although the share is suitable for me, it may not be suitable for you. And that's what the regulator tells me I have to say. I'm holding the share. I've been holding it since £1 here a few weeks back. So that's a share that's undervalued. It's growing earnings. This is not as good as I would like. So let's keep going. This is a North Atlantic trust, and it's been unprofitable, and it's just become profitable, and earnings per share is shot up from 0 to 2, and so if it's on a buy recommendation, but let's give that a miss. This is Serica. I'm holding Serica, and from just about here, in fact, and there's this earnings per share from virtually no money up till about 45 pence, and moving up the page in a nice trend up the page, and that looks good to me. I'm not in this share, but as we can see, the trend is intact, it's undervalued, and it's breaking up the page on a buy recommendation. So that's a software company, and the simplest of trend measurements will tell us that this trend is intact. It's growing earnings per share, and that's a software business, and that's certainly with a look. And that's a share that looks to me as if it can go quite a long way, that can quite easily get up to £2.50 here. So these are shares that are rising. This is diversified oil. I'm watching this share very carefully, and it's within this triangular formation, significantly undervalued, earnings per share growing through the roof. Not a great deal of history, but I think that can actually get up to 180 here. I'm not in the share at the moment. Ferro Petroleum, recently revalued as earnings are going up, but this earnings just not my cup of tea. This share, earnings per share growing strongly, doubled over the last 3 years. and pushing up the page very nicely indeed. That's the valuation. As you can see, these lows, the same at that high, and it's pushing up the page on a buy recommendation and a very strong trend at work here. So that's something that we could certainly look at. Spectrus sold off during October, November, December, but I think just about to break new ground here. Earnings per share good over the last 3 years, but this trend needs to establish itself. This has got a very poor history of earnings. DART has been very successful for me, and recently DART has pulled back. It pulled back with the global, the sell-off in October, November, December. It's pulled back to this trend line, and it's not on a buy recommendation yet, but as soon as that starts to move back up the page, then I'll certainly be interested in DART. Drax, I don't like this at all. I don't like this at all. This little company has done really, really well and is in the throes of a very strong trend up the page. Earnings per share growing, and its buy recommendation was at about £5, and it's now moved to about £7.50. So I'm trying to find shares that are in the throes of a strong trend up the page where the earnings per share is growing strongly. And as soon as I find them on the 3-year chart, then I would, on a weekly chart, then I would go right into a daily chart to get a much more entry point. Now, this is a great share, folks. Earnings per share is growing. This is the 3i investment fund. Now, the reason it pulled back like this is they paid a 16% dividend here. Okay, and it went ex-dividend there, and it actually came back to this long-term trend line, which is like so. And that's quite common, and it's now moving up the page again. This is a dividend play, and an exceptionally good dividend play. And as you can see, it started to go into buy recommendations down here. So this is a little bit of an anomaly. It paid a massive special dividend here. This I don't like. Impax Asset Management, earnings per share growing very strongly indeed. The trend is intact. It just needs to go into a buy recommendation and push its way north of this resistance. So that's certainly a share, and I think probably a share that should be bought and forgotten about. I also like this Lion Trust. As you can see, earnings per share over the last few years. Look at earnings per share over the last 5 years, in fact, has moved up from 10 pence to 50 pence, and it came back with the overall market over the last 3 months. But that share, to me, looks as if it wants to go very, very strongly again. So that's one that I'm personally looking at, and I always like to see where this resistance becomes support. And I'm doing nothing until VectorVest prints a buy signal here. Pearson, I don't like this. Certainly not. And this is a share moving up the page, not too much volatility. Earnings per share, not quite what I would like, and significantly undervalued. So that's something to have a look at. And Draper Esprit, no. And this Miton Group, again, another small asset management company, pulled back to this trend line, and we need to wait for a buyer recommendation here. So I've tried very quickly to show you how you could easily find some shares that are in the throes of a strong trend where earnings per share are rising. So any questions on that approach? Any questions on that approach, folks? How is this different from what how you've been picking stocks? I think Paul asked you to use any other indicators. I think, Paul, when you get down to the daily chart, you could, and you found a share that's in the throes of a strong trend with really good fundamentals, Then if you were a short-term trader, you could use the stochastic indicator, for example, to indicate a good place where the oversold situation, short-term oversold, is actually starting back into the trend. We have a setup for that. It's actually named after one of our trainers in North Carolina, a guy called Jerry. It's called Jerry's Gems, which looks at the stochastic indicator to really get a precise entry into a share with a good overall trend. Okay. So you can choose to be overwhelmed. You can choose to get your answers quickly. I want and I must have my answers quickly because I want to spend my time on what's really important. Paul says he's reading Elliott Wave and Fibonacci by Prechter. Yeah, it's a long journey, Paul. That's a long journey. I know Robert very well. It's a very long journey. And he's the first to say that he's a stock market academic rather than a trader. So great fun and an intellectual exercise, but I'm not sure how profitable it will be. I've been on that journey and I've largely given it up. So we now want to try and put this together. I think that, Paul, you need to make some money first and do some very, very simple things right if you're new to this. If you're not, I think Robert Prechter would be the first to admit that there's some very simple things that you can do to make some money in the stock market. When you're profitable, then you can start to make your edge a little bit better. But to make money in the stock market, it's all about perfect execution of a very simple system. First of all, find the very, very best stocks. And then secondly, make sure that you're in the market when the sentiment of the general market is good. And if you get those two things right, then you're going to push the probability of success up through the roof. So the plan. And the plan, in fact, that I'm going to speak about today was put together by VectorVest and Robert Markham, who is these days based in Australia. He's originally from Cape Town. And how to go from stress, totally overwhelmed, to consistent success. And if you remember, Rob took a hiding like many of us in 2007, 2008. And I was sitting in bonds in that whole period, and I came out of it quite well. Really important to know, is the market going up? Is the market falling? Everything follows from that, ladies and gentlemen, everything. And if you've ever been on a surfboard, you'll understand. Everything follows from that. He thought he was going to have to get a job, the poor bloke. Before he took that drastic step, he started to do his own research. He started to spend hours and hours and hours doing what I tried to do, reading articles, trying to put values to stocks. And he now got himself so confused that he felt it was inevitable that he would have to get a job. And then we sat down, we did this, and we put together this little matrix. When to buy, what to buy, and when to sell. So the first line. We need to know when it's safe to buy stocks. Now, you can use moving averages on the index if you wish. At VectorVest, we have a system called confirm calls that tell us when it's safe to be in the market, even as a conservative investor. So that's the first thing we need. When you need, I need, everybody needs that wants to be successful. We need to know when it's safe to be in the stock market. On the day that we buy, we would want to see the stock market rising. And we would want to see the share that we're buying rising. Now, most people will do that by putting a resting order above a high. So the share has to break out before you're filled. What to buy? It's very simple, and we've just talked about it. Share price rising, not too volatile. Earnings per share, absolutely vital. Earnings per share is the engine that drives the share price, and it should favor undervalued shares. Now, market exits are much more difficult than entries, and you're going to find that your moving averages, you're going to struggle on the exits because markets fall, as I think you all know, much, much faster than they go up. Just remember the old roller coaster. So we need some signal, the signal for entry in the market and the signal for exit to time the wave needs to be totally and utterly objective. And Paul, the problem with the Elliott wave is that it's incredibly subjective. And that book that you're reading by Prechter and Frost, believe it or not, in about 20 years ago, Prechter and Frost had a row about labeling a chart. And they didn't speak to each other for a full 20 years until old Frost was on his deathbed. And some people managed to get Robert to actually go and say hello to him on his deathbed. So the two authors of that book that you're trying to get your mind around, they couldn't agree on market timing. So you need some form of objective signal. So when to sell, market exit. I think we need a stop loss for every share in the market. Remember, in any portfolio, you tend to get two absolute flyers, 5 or 6 OKs, and one awful one. And it's important, unless you want to be like that guy in the T-shirt and that slide a while back, that you have a stop loss for every share in the market. And the third thing is that you need a profit target. Now, Rob in Australia had a very simple profit target. He exited when he'd made 3 times as much as he'd risked. Now, you don't have to do that, and that's something we'll work with you if you wish to try and get right. But you can use a trailing stop loss. You could use a more sophisticated trailing stop loss that we call the profit locker. But Rob in Australia used a profit target. I use a profit target personally because I am a swing trader. VectorVest will actually give you a green buy signal and a red sell signal, but you can certainly put your own version of it into your personal trading plan. And by putting that together, folks, making sure that he was on the right side of the market using VectorVest market timing tools and using VectorVest for fundamental and technical analysis, he managed to make his money back. And using this, he spends minutes a day managing his portfolio and giving him lots and lots of time to do the things that are important to him. So which area do you need to work on first? Certainly for me, it was stock analysis. I was completely absent out of what I was doing. Market timing is coming in here. So folks, if you're not satisfied with your results and you're getting buried and confused and kicking the dog, overwhelmed, and your results are like this old up and down roller coaster, and confidence has been kicked out of you, or you're not where you want to be, and you're not getting answers quickly so that you can focus on what's really important, and that's perfect execution. You can choose between stocks that are falling or being able to invest confidently for consistent results. Well, you've got some thinking to do. How can you create this for yourself? Well, you've got a choice. You can do it yourself, and that was me. With all those, I had many more annual reports on that piling up in the corner of the office. They piled up until we could hardly open the door at one stage. You can do it yourself. or you can break out of the mold and allow VectorVest to do all the heavy lifting for you. And to put this all together for you, I put together and professionally done the Successful Investing Quick Start course. And the objective is to show you how to put together all the building blocks to consistently outperform the market in 10 minutes a night. Now, old Einstein, I think he's been vastly overquoted here, but nevertheless, he said that everything should be as simple as possible, but not simpler. So there's work to be done, folks. And this is not a get-rich-quick scheme. It's for seriously minded people who want to grow their earnings, who want to grow their profits, who want to grow their wealth consistently and safely. Lord knows there's enough get-rich-quick schemes on the internet. We don't need another one. So you're going to have to roll up your sleeves for a week or two and make this material your own. Once you've got it, you've got it. The objective, of course, is more money, more security, and certainly more freedom. No sitting watching charts all day, every day. So I'm going to map it out for you over the 5 modules of the course. First one is a 30-second stock analysis system. And that will allow you, within 30 seconds, to fully evaluate any stock that you own or you're thinking of owning. So you'll be able to see whether the share is undervalued or overvalued. What's the earnings like? What's the earnings safety like? What's the trend like? And you'll be able to tick that off for every share that you're interested in 30 seconds. That will remove overload, and you'll quickly be able to separate the good shares from the bad shares in your portfolio. Now, lesson number 2, we refer to as weeding the garden. If you've got a portfolio already, we'll show you how to actually get rid of the bad. Getting rid of all those bad shares that are holding you back. So week number 2 is all about selling, and selling when you're wrong and selling when you're right, so that you can actually put into your plan exactly when you're going to get out, right or wrong, so that there is no thinking required when the little bar is bouncing up and down. We'll also talk about position sizing, and the objective is to minimize losses and maximize gains. So in module number 1 and number 2, we're going to show you in 1 how to analyze any stock, and in module number 2, we're going to get rid of all the bad ones. Module number 3 is all about market timing, making sure that you're in sync with that wave of sentiment. And on VectorVest, we call that becoming a green light buyer, because we've color coded when it's safe to be in the market with green. And all those signals are on the front page of VectorVest. They're on the front page of your app on your phone, and you can know in seconds objectively when the wave is at your back and when it's not. And that's 70% of the exercise. Week number 4 is all about finding the very best stocks. We've done a little bit of that this afternoon, but finding the very, very best stocks. And Paul will be using some of those indicators that you spoke about earlier. So cherry picking the very best stocks. Now, in this, somebody mentioned market noise right at the start of the presentation. In module number 4, we'll look at the Midas touch technique, which is just wonderful. I've never seen anything quite like it in terms of getting rid of the noise of the market. So lesson number 1, we're going to show you how to analyze any stock. Now, lesson number 2, we're going to get rid of the bad ones. And lesson number 4, we're going to replace those bad ones within your portfolio at a time when the general market is rising, which is module number 3. And in module number 5, we're going to put it all together for you so that you've got boxes to tick to direct your thinking, to focus you into 10 minutes a day. And that's the Successful Investing Quick Start course. In the US, they charge $475 for that. But when you're in the UK, if you give me 30 days, we'll use VectorVest to turn your portfolio around or get you started in the stock market, even if you've never been near the darn thing before. And that's the 5 modules. Now, in the UK, we're new, and we're doing that for £5.95. And if you're interested in working with us, it's vectorvest.co.uk/SIQSC. Now, I'm also going to give you access for 30 days to VectorVest UK and VectorVest USA. And you'll also have access via the app on your phone. And there's an app for both the Apple and the Samsung phone. And that's worth £49 on its own. Now, after the 30 days, you then can make a decision as to whether you want to keep going or not. And from there, it's £49 a month for both VectorVest UK and VectorVest USA. It's on a month by month, folks. There's no contracts. And my promise to you is that if you can't make money from what I'm talking about, then you can stop it at any time. And we're fully FCA authorized. That's not a rash promise, I assure you. We're also going to give you weekly group coaching. Now, I do a Monday afternoon presentation, which is recorded. You can play it anytime. And my colleagues in the US do lots and lots of presentations. We have a telephone helpline, which is open 12 hours a day from 12 o'clock midday to 12 o'clock at night. And there you can, in fact, get answers to your questions over the telephone. We have user groups around the country. I'm, in fact, after this presentation, I'm on, got to get myself to Paddington on a train to Taunton for a user group in Taunton this evening. We had one in Guildford last night. So we have user groups around the country, and those chappies up in Manchester, well, we have a outstanding user group in Manchester run by Stuart in Manchester. So that's a part as well. So, and that's all for that £5.95. VectorVest.co.uk/SIQSC. And literally hundreds of people have been doing this. This is Tom. And he says that I've even got a written plan after all these years. Okay. So that's been quite a mission to get him that far. And hundreds of people have done this around the world, folks. These are all from the US, but lots of people have done it in the UK. Process is similar. It doesn't matter where you are, whether you're in the US, whether you're in the UK, whether you're in Australia. The process of finding stocks that are rising with great fundamentals, undervalued, growing earnings strongly and safely when the general market is rising is common to all stock markets. So we talked about the mistakes. Which one of those is costing you the most? And certainly for me, it was stock analysis and the fundamental side. I had my head stuck in the sand. And as I say, when I added that dimension into my trading, my results became much, much, much better indeed. So VectorVest.co.uk/SIQSC, that's the 5 lessons, and it's £5.95. So it'd be a great honor and a pleasure to work with you. VectorVest.co.uk/SIQSC. And folks, if you don't think it's the best $5 you've ever spent, well, you can have the $5 back with the greatest of pleasure. Thanks, Paul. I look forward to working with you. That'll be great. Thank you. And it would be great if you could make the trip to the Manchester user group. A great, great, great bunch of guys. I'm telling you, a really great bunch of guys. So if it's not if you don't think it's the best $5 you've ever spent, you can have it back with the greatest of pleasure. Okay. That is our, and thanks very much, folks. I've kept you a little bit later than I wanted to. If I can help you in any way, yeah, Paul, you'll get an email from us, re that Manchester user group. I'll in fact be there. It's on the first Tuesday of every month, and I don't go to the mall, but I'm going to be there in the first week of March. So, folks, it'll be great to work with you. And that's the link. If I can get it back to there. There's the link. VectorVest.co.uk/SIQSC. Thank you very much for listening. And just remember, 70% of the exercise is the general market. Find yourself some shares with outstanding fundamentals that are rising, and you've got it licked. Think of those 4 problems I talked about. Have a great afternoon, folks. Take care of yourselves. Bye-bye now.